Welcome to Yield Nerd, an educational show about how you can acquire and manage yield.
All right, Yield Nerds, we are getting ready to celebrate July 4th, and I thought I would end the weekend with a couple of quick messages, a year end recap on how you can potentially increase your duration. We'll talk about what that is, and at the same time, balance taxes and have a higher yield. New subscribers, quick thing, there is a link to a playlist. You can find that right there. That organizes the show in sequential order. You can also see latest yields on yieldnerd.com. My usual disclaimers, I am not here to preach any particular product. I don't have sponsors, and this is not about politics or any kind of guidance. I am not a wealth management advisor. All right, quick things about today. We're going to look at where we are, how we got to where we are, and then touch upon high yield bonds, which is this really hot, amazing, incredible thing. Just kidding. And compare that to the yield curve and see where we go from here. A little bit of the background, not that you don't know this. We started from next to nothing in interest rates just 3 short years ago, and we have gone up astronomically. And in all likelihood, it may be a little bit higher. Who knows exactly how much? The mantra that is used is higher for longer. And if you can remember higher for longer as a guide to your actions, in all likelihood, you cannot go wrong. There is a wonderful Reuters article. The link is posted here. The title is 6 Questions Facing Stock Investors. As you look at the second quarter, and I gave you the suspense, how much better are you by owning stocks than bonds? And let's see what that is. There is a particular index that is called the stock versus bond equity risk premium. The equity risk premium says, hey, how much more are you going to pay me because I'm taking a greater risk and owning equities? As you can see, if you bought stock in 2012, you were rewarded tremendously for owning equities versus bonds. And if you bought stocks now, doesn't look that good. Let's dive deeper. What the moral of the story of the Reuters article is that even though the S&P has gained a really nice chunk, that is mainly because 5 or 6 companies, I won't name them, you know who they are, 5 or 6 companies grew in a phenomenal rate in terms of their stock price, not their earnings, but their stock price. But the rest of the market barely crawled along. If you own treasuries, you would have grown by 5.5% state tax free. If you had an equal weighted index, you would have grown by 4.2%. What does that market say? The market is saying that outside of pretending every company is one of the top 5 companies in the S&P 500, and maybe you are one of those, maybe you just want to invest in these big mega caps, and that is all you want to do, and you do you. The rest of the market is not that. Eventually, when there is a downturn in the rest of the market, it will come back to the top 5. But hey, who am I to predict these kinds of things? So having said that, I am squarely staying in bonds, except for small exceptions. I'll tell you how I'm thinking. Let's talk about high yield bonds. A quick refresher. There is an SEC article. If you can Google what are high yield corporate bonds and look at the SEC website, it gives a very nice definition. It says, hey, these are bonds that represent debt issued by companies that are levered very, very highly. You may remember in our discussion in the value investment module that we look for companies with very low debt. This is the opposite. These are companies that may have 80 cents of debt for every dollar in equity, sometimes $1.50 of debt for every dollar in equity. So very, very highly levered companies. They have a risk of going under because if you do not pay the bondholders, they are going to come get you. And it also could be that it's an unproven company, it's an early company, and they say, we'll just pay you a lot because we want to raise debt. And bond ratings go from AAA to AA to single A, BAA, BBB. This is even lower than that. So junk bonds or high yield bonds are those that have very, very low credit rating. Yield nerds, yield curves do not discuss junk bonds only because I personally, this is just my opinion. If you want to buy junk bonds, you can also buy lottery tickets. There are a lot of things you can do. And so, you could buy junk bonds. You could have bought junk bonds, a couple of years ago, and they would have paid 5.5% when the federal interest rates paid 0.25%. At that time, it would have looked like an unbelievable thing to buy. Today, the high yield bonds pay 6.5%. They are taxed at a state and federal level. There is no capital gain. And even if you own an ETF that you think is a composite, that you think is an investment grade ETF, there is a small leeway they get. Anywhere up to 25% of the total portfolio may be high yield. Now, why do I keep talking about high yield? As interest rates stay higher, it may be tempting to jump to higher yield and say I can get 6.5%. But remember, those same highly leveraged companies will have to pay a high coupon to their investors, and they aren't making enough money. And so this is going to create a problem, and those credit ratings will slip. And if you own those ETFs, your ETF net asset value will crash. What is the moral of the story? Holding a corporate bond ETF headed into the next half is pretty risky. Holding a stock, as we saw earlier, the premium is really, really small. And even if you think you're holding investment grade ETFs, read the prospectus, you may be holding some high yield. So our hypothetical story is the following. If you bought $10,000 in an investment grade bond ETF about a year ago, you probably are 15 to 20% down for the simple reason that interest rates have gone up by that much. And for all the reasons we reviewed earlier, the blend of high yield and so on, you are hurting. And the ETF probably pays around 6.5%. You can sit here and say, hey, treasuries only pay 5%. I'm getting 6.5. I'm coming out ahead at the end of the day. But given the mantra of stays higher for longer, the rate stays higher for longer, here's what you can look at. You can buy a treasury today at 5.47%. And if you add the 6% tax back, this is more like a 5.8%. You can buy agency bonds at 6%. This at the end of the day is equal to or better than a high yield bond only because the credit rating on these are AAA, not under BB like a high yield bond. And so you do you. You can also, if you have a cluster of bonds, you can sell a single bond. If you own an ETF, you can't sell a part of the ETF and keep the rest of the ETF. You're selling shares in the entire portfolio. And if you're buying individual bonds, you can buy them at a year, 2 years, whatever your duration is. And as long as you hold it to maturity, if it is an agency bond or a treasury, you know your money is good. And so you will get your money back. An ETF does not guarantee you that. If you bought a T-bill, for example, and the T-bill sold for 98 cents and a year later it's going to become 100 cents or $1, for example, if you sold that T-bill midway, you will always sell for a profit because that is how it works. You bought it for 97 cents or 98 cents. As you progress towards maturity date, the value of it keeps increasing until it reaches 100 cents on the date of maturity. So you can't lose owning those. All brokerages do not have any fees for buying treasuries. There are fees for agency bonds, watch out. ETFs do have fees. ETFs fees are much, much higher than agency bond fees are. You can do your own math. Agency bond fees in popular brokerages are $10 for $1,000 a purchase. ETFs may have 1% and much, much higher, sometimes 2%, so be very careful. And YieldNerd membership is free for those who buy individual bonds. I'm kidding, it's always free, but it's a lot of fun to buy individual bonds and understand yield. So what is the YieldNerd move that I'm making? And you do you. If I find corporate bonds, if I found what I thought were investment grade corporate bond ETFs that have high yield components, I no longer need those junk bonds because I can buy AAA bonds that pay pretty much the same thing. Even if I'm selling at a loss, let's say I'm down 5%, if I bought a 3-year agency bond that pays 6.36% before taxes, I can just use that to bury the loss in the first year and come out even the next 2 years or ahead the next 2 years. You do you. This is education and not advice. And just so you know, I have a substantial portion of my bond portfolio in the less than 1 year duration. I am buying equities in specific sectors where I believe there will be trouble later on because gas production is much lower, and as demand increases, unfortunately for the country, prices will increase. Food is going to be very resilient. These are my opinions. You do you. So I am putting money into equities in those areas. And in terms of bonds, I'm increasing duration very carefully. If I can get more than 6%, I don't care about the next 1/4% that Chairman Powell will increase. I'm happy with 6% plus state tax. So I'm increasing duration in those areas. And if there is going to be a bull run, I'm okay skipping the first 3 months. I will jump back into it after it starts. That is how I think. You do you. Thank you for listening to Yield Nerd. Have a lovely 4th.
Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.